Welcome to America's Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thank you for being with us. The excitement is brought to you by ArborCrowd.com for professional crowdfunding. Whether you're a sponsor or an investor, visit ArborCrowd.com. Well, today we're going to talk about multifamily. We're going to talk about the apartment industry, and there's certainly a lot going on with demographics, and we're going to talk about the impact of some of the new supply that we've seen in the marketplace. We're also going to talk about the impact of rising interest rates. What might that do to the market? We're going to talk about property performance trends, what we're seeing there, and cap rate expectations. And then finally, we'll talk about some financing. What should we expect moving forward? How should you plan for it? Please welcome my first guest. It's Jay Parsons, and Jay is VP of Analytics with RealPage. Their website is realpage.com. He's joining us on the phone today. Jay, thanks for being with us.
Thanks for having me, Michael.
So Jay, what are you seeing in the apartment world today? We've finished the second quarter. What's going on?
Well, it's more of the same. The apartment market is doing well. We're certainly past those peak rent growth days, but anybody who was predicting dire stretches for the apartment industry at this point was likely wrong, except for maybe a few niches of the market. Overall, still a ton of demand and still at least solid rent growth.
Yeah, so we had seen really strong rent growth, right, for the last several years. So you're seeing that slow down now to more maybe normal area records? Ratios?
Yes, we've been seeing rent growth year over year in the mid two to high twos range now for a couple of years, and it seems to be settling in that range. Now, we do think there's actually potential to get a little bit better going forward for a few reasons we could get into, but the key point here is that there had been some concerns by some investors and some analysts out there that rent growth could really flatten off for the U.S. overall, and that's certainly not happening.
So I heard you said there might be some potential for an increase in rate growth. Tell us where that potential could come from.
Yeah, Michael, we've talked about this a little bit in the past, and and how the importance in this point in the cycle, you really have to segment the market. And the apartment industry is so big, 20 million units across the country, and so obviously what's happening in one segment or in one market or in one submarket could be very different from what's happening elsewhere. And so we go back 3-4 years, it's rising tide boosts all ships. Everything's blowing and going. It doesn't matter if you had the worst locations, the worst operating philosophies, you're still probably successful, and that's just not the case these days. And so what we're seeing is that in those the right suburban areas and in the Class B segment overall, there's still a lot of strength. And we think that what we're starting to see is that the operators in those segments are starting to figure out that vacancy rates are still low, affordability is a non-issue in those segments. No one's obviously building Class B supply, and in the best suburbs, it's very hard to build. And so I think what we're finding is that there's potential to keep the pedal on the metal, so to speak, and get some decent rent growth in those spots. And so that segment could very likely help drive overall a modest increase in overall rent growth, while Class A and urban continues to underperform.
And what are some ways to achieve that growth? Is it through technology, through better management, or just selective investing?
Well, I think it's all the above. Obviously, when you're 9 years into the cycle, the best operating philosophies and the best investment strategies are what's really standing out. And so certainly, getting a little more into that, if your belief was that you had to be urban to be successful in this cycle, and you bought all in on the idea that every millennial wants to live downtown, then chances are you're not reaching your pro forma NOI numbers right now. Conversely, if you saw that the indicator showed, there's in the right kinds of suburbs, if we could really categorize the good versus the bad and separating out your aging suburbs with a burned out Sears and a Pizza Hut with a big parking lot versus these more urban-like suburban areas and growth markets with high-end employment, access to transportation, retail, restaurants, high home prices, good schools, and in those segments, as well as the Class B overall, we're seeing just a lot of strength. And for those who are able to bet on that early, it's really paying off. And secondarily, of course, technology and operating management is a big piece of this as well. I mean, certainly we continue. We're obviously big believers in revenue management, and we're continuing to see, those who have been ahead of the curve there see that pay off.
Yeah, revenue management's a pretty incredible tool, and most of our listeners don't know what that is, but that enables you to use technology to know what your competitors are doing, what's coming up in your unit, and kind of take those rent increase decisions and change them daily, like the hotel industry. And you mentioned that some of the investors who may have went all in on urban may not be hitting their pro forma numbers for buying these very close in-town properties. Is that because of new supply, and where are we on new supply levels?
Absolutely, you nailed it. The issue is not that there isn't demand downtown. I mean, there's a ton of demand downtown, and we're getting more demand than ever before, really across the board. One of the things is everybody's been focused so much on supply and moderating rent growth, both downtown and really across the board. The demand story cannot be undersold. There's a lot of demand out there, and even as the older millennials are leaving and buying homes and whatnot, there's a lot more demand coming in the front door, and so that's a very good sign for the industry. But the issue, as you mentioned, it's supply. And what's happened is sort of a perfect storm where over the last couple of cycles, a lot of the cities across the country have incentivized downtown revitalization. They really want to bring in residents to help bring in more of a 24-hour life to these downtown areas. On top of that, there's been a big movement from commercial real estate investors to favor the downtown story for a wide variety of reasons. It's gotten a lot of attention. And so because of that, we've seen this huge surge in development activity over the past two cycles. And so, and that hadn't been, and we had not seen that in the prior few decades. And so what's happened is that, well, you have a lot of really unique, cool product and great locations. We've sort of commoditized the unique, great product and great locations, and so it's all competing with each other at a very high price point. And there's just a limited, there's plenty of people out there, but we're building so much supply so fast that it's hard for demand to keep up. They're also competing with properties that recently completed lease-ups. So you get a deal at one property across the street is offering big discounts to move in during their lease-up. It's very easy to take your stuff and move across the street because so much supply is in a walking distance in a lot of these cities across the country. And so it's just become a very challenging pricing environment. It's just hard to get a lot of rent growth. Now, long term, many of these properties are probably going to do great. It's certainly not to say these investment strategies were bad ones. It's just that at this point in the cycle, it's a very challenging environment to get much on rents.
Well, are new supply levels going down, or what are we doing? Are we still building?
Well, it's not going down, but the good news is it's not going up either. We're often asked, when's that peak? And what we're seeing in this cycle is it's not so much, if you think about it in terms of visually, it's not a peak like a mountaintop and you slope back down. We're seeing more of a plateau. And so we've been a little north of 300,000 units completing annually now since the first part of 2017. And as we look into the future and look at what's actually breaking ground, what's underway, we're going to remain at these levels likely through the first part of 2020 until we really start to slow down. There just hasn't been that big drop off in supply and permitting. It's just not happening. Obviously, it can't persist forever, but the market's still strong enough to justify continuing starts in a lot of these markets.
Yeah, well, it's a healthy market. And we're talking with Jay Parsons with RealPage about the multifamily market. And Jay, you mentioned that there's some new demand coming. So where is this new demand coming from for multifamily?
Yeah, what's happening is I think in our industry everybody gets so focused on generations of demographics. We tend to categorize our residents in terms of the generation that they're in, and so everyone's very focused right now on millennials. And so because of that, because we got so excited about millennials earlier in the cycle, now we've gotten ourselves worked up that these millennials are now in their mid-30s, the oldest ones are, and they're at that age when, even though it's taken longer to get married and have kids and get a single-family house, they're now at that age where they're going to be doing it, and that's caused some fear-mongering a little bit. And And there's some people who say, "Hey, that's not going to happen," but the reality is it does happen. People, at the end of the day, what we're seeing is that the oldest millennials are going to behave more similar to their parents than not. But is that just because someone turns 35 and moves out, or 32, whatever that age is, you also have to bear in mind there's still people who turn 20 and 21 and 22 and 23 every day. And the good news for us as an industry is that the peak age group is still in its early to mid-20s, and so there's a lot of people who are just entering that prime apartment renter age for the first time. And so there's a lot of people aging up and to replace those who are moving out. The other great thing for our industry is the baby boomers and older adults. We're not big believers in the concept that we're going to see this huge shift in preference of people selling their homes and renting an apartment. But it doesn't really matter, because the reality is that the baby boomers are so big that even if the percentage or the share of older adults choosing to rent apartments stays stagnant, you're going to see a huge increase in demand just by sheer numbers. The baby boomer generation is twice the size of the generation before it. And so there's a lot of good demand drivers still in place for apartments right now, coming from both older adults and from these younger adults.
Yeah, well, it's interesting because I'm a baby boomer, and I have a little place up at the lake and a little place in town, and I think I'd be open to the right apartment rental in town myself, and just for the convenience of it, not have another property, another home to maintain, right? So what do you expect for impact of rising interest rates and cap rates, or is the multifamily community kind of concerned about what's going to happen there?
It definitely is a lot of talk. I think that as we really start to see this play out, you talk to investors, you talk to lenders. What we're seeing is that it's not really affected deal flow. What's happening is you may be changing a little bit of the financing structure of some of these deals. It causes some differences on the margins, but the reality is deals are still getting done, and even as interest rates increase a little bit, the spreads remain very attractive relative to previous cycles. So we aren't at a point where we're really seeing an impact on deals getting done.
Okay. And what would you leave our audience with, Jay, related to multifamily today?
Well, I would just continue to emphasize that that it's a diverse market, and there's a lot of demand still out there. And certainly the market isn't what it was in 2015 in terms of just rent growth across the board. But if you're an investor, there's still opportunity out there, and I would just encourage you to really evaluate your investment strategy, your criteria. What do you, maybe the things that challenge your assumptions. If you feel like there's just not opportunity out there, look at your assumptions and figure out, okay, well, if we can we, without having to do the so-called feared, chasing yield play, are there options out there that may be less risky than we've perceived historically, based on some of these things we're talking about? And so there's definitely still opportunity out there for investors, and I think for operators, it's just continuing to let the technology, revenue management, and the science guide you. Not overreacting when someone moves out or you got a bad month. There's, like I said, there's still a lot of demand out there, and I think the number one concern to really be watching for on the operations side is just overreacting to micro trends, because again, the overall fundamentals are still quite healthy.
Yeah, you got to watch. If you're just watching the headlines in the news, don't overreact to it, right? Jay, great information. Thanks for joining us, sir.
My pleasure. Thank you, Michael.
And stay tuned. We'll have more on the U.S. multifamily market, some strategies and some tips. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.